Today, we discuss a stock that's hit the buffers after a runaway period, a sector that still has a supercharged feel to it, and some investment trusts operating in a more unloved part of the investment universe. We'll begin with Marks and Spencer, whose strong performance in recent years has been stymied by the huge cyber attack it suffered earlier this year. Partial namesake Mark Robinson will discuss the retailer's half-year results shortly. Then it's on to our big read, quantum computing, a part of the market that's roared ahead this year, even by US standards, amid signs of technological breakthroughs. But will we ever reach the long awaited point of quantum advantage, whereby traditional computers are superseded? James Norrington tries to fathom the unfathomable later on. To wrap up, we will look at the UK's trio of global healthcare trusts and the restructuring plans afoot at two of them as they bid to move on from the sector's underwhelming performance in recent years. Val Cipriani will be here to talk through the details. Marks and Spencer, to get things started though, as I said, half-year figures released the other day. Mark, you took a look at them. This is a company now very much in recovery mode, despite the huge share price run-up seen last year in particular. What did we glean from the results about its near-term performance and how it's moving on or trying to move on from that cyber attack?
Well, I think the noises there were generally quite positive, but I think investors will be looking between the lines to just see how that recovery is panning out. Most of our listeners, I would imagine, have had experience of the difficulties that came about because of April's cyber attack. And of course, it's certainly reflected in these figures as well, because reported returns were virtually wiped out over the period, while underlying profits, they contracted by about 55% during the period as well. The strains were evident elsewhere within the results as well, because operating free cash flow stood at £193 million. Well, that was an outflow against an inflow of 21 million last time around. So the results right across the board were dominated by the cyber attack itself. The costs there will total around about 136 million, but I don't think that's a definitive figure at this stage. And there'll be about 34 million going over the final 6 months of the financial year as well. Of course, it's worth remembering that these will be at least partially offset by insurance recoveries. I think that was pitched at about 100 million. But you're left with the impression, looking at the results, that that may not be the end of it as well, because there's still ongoing costs in relation to stock management in the fashion and home and beauty segments, and also we've seen higher markdowns and wastage in food, or in that case, that's tailed off a little bit, I believe.
Yeah, I mean, the fashion, the home side does seem to be a bigger issue, doesn't it? I mean, clearly the website was down for a lot of the summer. Food recovered relatively quickly. We'll go into that in a minute, but the fashion side of things, sort of double-digit drop in sales, as you would expect, given the offline nature of the website. But it's also interesting, the recovery is perhaps a little slower than some had hoped. M&S was still rather, I wouldn't say ambivalent, but it was cautious about its prospects for recovery in that division. It's saying it's on the road to recovery, not there yet. I mean, part of this relates to, as you said, inventory and stock management. On the earnings call, they were talking about the fact in fashion it takes a bit longer for the stock to flow, for systems to reconcile, so we know exactly where stock is, which is clearly a big issue if you don't, especially when you're coming into a new season as well, in terms of things you need to have on the shelves. So it sounds like they're still a little worried about the amount of stock they'll have coming into the winter season and whether they have the right stock.
Yeah, that's certainly the impression I got as well. And that's why I made that point before about reading between the lines as well, because they've obviously had to take on these much greater stock management costs in those two divisions as well. And as you say, sales were down by about 16% there as well. They had to use, there was a temporary use of onshore resources in a bid to restore the infrastructure and the systems behind that as well. But yeah, I guess in a way, you could say that they would have been committed to these type of changes anyway, at least in terms of the long-term modernization of the supply chains linked to fashion and indeed food itself. And the company has been building up its technology infrastructure and capacity for a while there now. The recovery has been two-paced really as well, because you got home delivery that resumed first, and then it was followed by the click and collect, and that didn't come back on until about August time too.
Mm.
But the store sales themselves were impacted by uh, reduced availability. I found that myself, going in looking for stock from time to time. Not that I'm a typical shopper in any ways, but it just led on to sort of fewer visits linked to the absence of the click and collect function as well.
Mm. Well, they did say one thing we should say is that it sounds like from a brand perspective, the damage hasn't been too bad. They would have lost clearly some business in the summer to rivals, but they pointed to, I think, some of their brand ratings being high as they've ever been in terms of surveys. I think they said on the website, traffic was up 20% year on year in September, albeit they couldn't necessarily fulfill, I imagine, everything everyone wanted, but that's still a good sign. At the same time, it is going to take a bit longer, as we've said. Why don't we talk about the food side, though, because that is still performing very well, is recovered fairly swiftly, as you'd expect, perhaps. It's a slightly more straightforward process to sell food, and the numbers there were pretty good for the first half as well.
Yeah, when you're taking it, the food sales are just up by about just under 8% as well. So, given the circumstances, that's an extremely good result. I do recall years ago, and I don't know how true this is, but it was often said that the food segment within M&S stores was there solely to get people into the stores themselves in the hope that they would go up to the other segments and buy in. But now it's become central to the whole business operation itself. Um, the good thing there is that even though I did have those points linked to wastage and sort of markdowns, the gross margins there have now recovered fully. Um, and customer availability and supplies have recovered there. I mean, it's been a great part of the business for ages now. So, with the systems are now have been restored, so those issues linked to markdowns and wastage, they've reduced to a large extent,
Mm.
and those operational metrics are now back to what they were.
Yeah.
So, yeah, pretty good from that perspective.
Yeah, and they still have big ambitions here as well, don't they? They're looking to double the size of the food business from current levels over the long term. There's a store
Yeah.
opening plan to infrastructure investments to help achieve that. So, I mean, it's going very well at the moment, and certainly customers are on side, but I think there's a lot more to go. So we'll see how that fares. We should say, though, regarding these figures too, the indication, one of the biggest indications that the effects of the cyber attack are still lingering is that the company said it expects second half profit to be at least in line with last year. Uh, but expectations were for a rise of around 10%. So they're still a little bit off that, it looks like, at the moment. And
Yeah.
we should talk about our own recommendation on the company as well. We did have them on a buy. We've gone down to a hold. It's fair to say partly because of all the issues we've just discussed, but also because of the underlying softness, the word I keep hearing people say in relation to the UK market, the UK economy, and the fact, of course, we have budget uncertainty this month in particular too. Is that fair to say those are the reasons for the downgrade?
Yeah, definitely. I mean, looking at them as well, their relative valuation to peers in this space. I mean, they trade a substantial premium to peers on that basis, but then again, they always have. I was more concerned what's going to happen with the budget in terms of discretionary incomes, and normally, that doesn't necessarily apply to sort of food items. But in the case of M&S, that's a slightly upmarket affair there. So there's a possibility that consumers might start to trade down if those tax charges are as bad as conjecture would have us believe at the moment as well. So, the combination there with that high rating, I was just thinking at the moment it would be prudent just to take a step back and see how things pan out. But I mean, the main takeaway from the results is they've coped admirably in a sense. Things are restoring, getting to where they are. Possibly not good timing considering the budget, but the full year results will obviously be more instructive just to see how things have returned. And who's to say that once things are back on an even keel, that it might be an enhanced operation given the technological changes and those to the supply chains as well.
Well, speaking of technological change, we're going to turn now to our cover feature this week, all about quantum computing, an area that's attracted a lot of interest in the past few weeks in particular, and the past year in particular. The interest has been increasing quite significantly for a while now. We'll get on to some timelines in a minute, James, but why don't we talk first of all about some of the developments we've seen recently, and also the bigger picture about what this ultimately is all working to, and why there is such investor interest in this space at the moment. Albeit some of that interest is quite speculative by its very nature, but there are at the same time concrete reasons for excitement at the moment.
Yeah, so quantum computing, it very much sort of sounds like science fiction. But basically, what's happening recently is we're seeing more and more claims of something called quantum advantage, which is sort of a point at which real world tasks can be done by quantum computers in timeframes that are wholly impractical for classical computers. So, for example, HSBC using a solution developed by IBM, who've been one of the leaders for a long time in developing quantum computing capability, was able to successfully trial an algorithm predicting for fixed income trading, and they were 34% better in classical technology at filling orders, so improving the liquidity in fixed income. So that's a real world use case that potentially could be rolled out. Also, in the last month, Google has with they've got a chip and an algorithm. It's very much a hardware and algorithm combination with quantum computing, as we'll come onto, that was able to analyze subatomic reactions 13,000 times faster than a classical computer. Now, that sounds a bit sort of abstract to a lot of people, but what it could potentially mean is impacts on things like drug discovery, which is obviously a multi-billion-dollar industry, and testing things like space-age materials, which as we sort of explore outer space, as we look for more heat-resistant and conductive materials with energy transition, these are potentially very, very big breakthroughs.
So, as you've alluded to there, the underlying hope for quantum computing is that, or the underlying wish is that we get to a stage where there are practical applications from these computers, which effectively mean that the classical traditional computing power is superseded many times over, and that will, as you just again remarked upon, have all kinds of implications for all kinds of sectors. It's not just a case of doing things faster. It's, in some cases, it would be a case of completely overhauling how things work. One area in particular would be, and we're still very much in the realms of the hypothetical with this, but it would be in terms of encryption and in terms of cybersecurity and things like that.
Well, I mean, this is sort of one of the high threshold use cases, but it's the one that people are most frightened about. Most of the internet is worked on keys, which is based on and encrypted with based on something called RSA, which is I can't remember the names of but that RSA encryption is basically the acronym of the people who developed it. Now, there's been a theoretical algorithm developed by a guy called Peter Shaw about 30 years ago. In 1994, I think he did it, so 31 years ago, but which can theoretically crack RSA encoding, but we've never had the computational power to do it. I mean, it's theoretically possible, but it would take, because a classical computer works in bits, 0, 1, 0, 1, 0, 1, the number, they would take it many thousands of years theoretically to crack an RSA encryption. We've got a lot nearer this year to being able to generate the computational power overhead with a quantum computer, theoretically still, but a lot nearer theoretically to be cracking RSA encryption. And that is very exciting and very frightening. We were talking about Marks and Spencers and being hacked at the top of the show. There's a real risk of that hackers who've harvested data from all over the place on the dark web will be able to decrypt it rather, in the future when they have this technology. So it's absolutely imperative cybersecurity to be prepared for this Q-day moment when quantum can actually break RSA. And actually, what the good news is that there are algorithms available which can do that protection, and companies like Microsoft and Amazon Web Services are incorporating those. So we should hopefully be ready for it.
Indeed. Well, if that moment comes, there will be quite significant consequences, as you've just outlined. Some people clearly have differing views here, and some people have changed their views as well, because Jensen Huang, the CEO of NVIDIA, at the start of this year was saying we were still decades away from this moment of quantum advantage when quantum computers can override or supersede classical computers. But he's moderated his language this year, hasn't he? And some people think, because of the kind of developments that Google are now showing, that kind of thing, that we might be a little bit closer to some of these moments where we are seeing practical applications come through.
The skepticism around actually being able to break RSA, which had actually prompted a bit of short selling of quantum stocks at the start of the year. These guys are getting squeezed quite a bit at the moment, it has to be said. This was born of the fact that there's a high level of overhead in terms of the qubits that need to be developed to apply Shor's algorithm to crack RSA standards. Now, there's been a big breakthrough at Google in terms of the algorithm used in terms of folding the qubits in the reaction to do the calculation. So theoretically, it's gone down from 20 million odd qubits to 1 million. Now, that's still 1,000 times more than a quantum computer can generate. But the direction of travel is clear. And on the hardware side, the stability and something called the fidelity of the quantum computers is also improving by orders of magnitude, which means that we're getting to a stage where we're going to need fewer qubits to do a reaction on the algorithm side and on the hardware side. And there will be a point when this potentially converges. And this really, it's impossible to say when this might be, but it could be 2030, it could be 2035. The point is it's now no longer such an abstract science fiction concept. It means that that the NIST algorithms, the quantum proof algorithms, that's something that cybersecurity firms are going to have to incorporate. People are going to have to assume this might happen.
Yeah, better safe than sorry when you're dealing with such a potentially consequential thing, I think. Let's talk about the tech giants then, because they are making investments in this sector. They've got their fingers in many pies, clearly, but they are taking a greater interest in quantum computing this year or in recent months, NVIDIA included. Part of the reason maybe why the CEO is changing his tune, or chicken and egg situation there. But can we talk a bit about some of those investments and what they're looking at?
Well, we know obviously NVIDIA has very deep pockets and a lot of cash, and NVIDIA's Ventures, sort of effectively their sort of venture capital division, has become a major partner of a firm called Quantinuum, and invest in another number of quantum firms. And they're interested in this technology because it is a perfect partner for AI. If you think about the bottlenecks for AI, their energy and their computational power, because if you're thinking about sort of the amount of thinking an AI has, a large language model has to do in binary bits 0, 1, 0, 1, 0, 1, to ask to do complex tasks, that takes a hell of a lot of time and it burns a hell of a lot of energy. Now, with quantum computing, potentially, the prize here is actually to be able to do this in shorter times, shorter pathways. You get to answers quicker. You don't run into the bandwidth you get in some cases with using AI. and also, it's in terms of the power required for the data centers. It's more like, I think I spoke to one analyst who said it's going to be equivalent of a data center which could run off the power of a couple of refrigerators versus a small city to run which is what it could cost in terms of energy to power, and obviously environmentally, that in terms of water usage, in terms of energy usage, that's one of the big objections people have to AI that could completely disappear. And furthermore, it's when you think about the security issue, when you think about the fact that there's real world economic value in terms of testing in the pharma industry, in the energy industry, in materials and manufacturing. Suddenly, the elusive real world applications, which is possibly one of the reasons around the jitters around some of the AI stock valuations at the moment. There's some of that. Suddenly, we're back to the races again.
Yeah, if of course we get to, or if and when we get to that stage in a few years' time, but it is certainly, you can see why it's an enticing prospect for them, as you've just outlined. Let's talk about the quantum computing stocks themselves, though, the smaller companies, US listed, which really have seen a huge run up this year in particular, partly on all the things we've just been speaking about. As you also mentioned, they have sold off a little bit recently, but only marginally in the grand scheme of things. I mean, there clearly is some froth here because these are pre-revenue companies and there is a lot of hope maybe being built into valuations, as happens with early stage companies. But at the same time, clearly a lot of investors are buying into this, and companies too, as we've outlined.
Well, they're not necessarily pre-revenue; they are pre-profit. A lot of them,
yes,
and their focus is very much on scientific development. But companies, and these are mostly listed on the Nasdaq. So US companies, Rigetti, which is up 200%. D-Wave is also a multi-bagger. IonQ up about 50%. IonQ is an interesting one. It's just had a breakthrough with stability of its quantum computing that relies on a method called trapped ions rather than superconductivity, which is the method that IBM and Google have predominantly used. Although it has to be said, the big firms are investing a lot of other iterations of quantum, so they've got fingers in several pies. But the focus is on scientific development. So you want to look at sales, cash burn, and the ability to raise equity from backers. So it is kind of speculation. So you're kind of following the money to see if they're going to rise. So the thing to count for is things like enterprise value to sales movements in that. Now, obviously, the enterprise value is going to keep going up, but the multiple, the more that big companies like Nvidia and Microsoft and Alphabet are investing in them. But you also want to look at free cash flow, their ability to raise money, and look at trends in cash from operations. Is that improving? But there's some very exciting things. Quantinuum, which was it's partly spun out from Cambridge University quantum computing, which is a merger with the quantum division of Honeywell, which is a US listed stock, which you again another US play on it, in part. But so that the prize for the big investors is as we've said, is that quantum could be the secret sauce to sort of scale the AI revolution, so it's kind of, that's why they're into it, and you can follow the money if you want to speculate on this, but it's very much an investment for fun money and a very small slice of your portfolio. So it's a fascinating technology. It's just one of part of the joy of investing is sort of that hobby aspect of it, where you get to educate yourself about what's going on in the cutting edge and feel like you've got a bit of skin in the game. This is definitely one of those, but it's definitely a very speculative play, and readers should not commit any money that they can't afford to lose.
The thing that interests me with some of these share prices this year is they've been, as a momentum speculative trade in some cases, their prices have been going up almost in tandem with Bitcoin, where if you think about the ultimate consequences, one thing we haven't really spoken about is if we get to that quantum stage, you would break the Bitcoin encryption. It really seems like these are two sectors which should be moving inversely in a way, but maybe that just speaks to the market in general.
Well, quantum-proofed encryption, there are some blockchains that are more capable of adapting to it than others. I mean, I won't ask you to pardon my French, but the term for rubbish coins that rhymes with Bitcoin, those type of blockchains, they'll be easy to crack, and that's just another sort of Dutch tulip speculation that can go badly wrong. Bitcoin, that's something, because it's quite an old blockchain, that will have to adapt. One of some things like Solana, that supposedly says it is working on being sort of quantum proof. But again, there is going to be an issue. Blockchains are going to have to think about how they incorporate some of this these NIST technologies, but also quantum will be able to come up with its own defense and algorithms itself. So it's a fascinating space. But yeah, it's something that you should be sort of careful of if you're. But I mean, you shouldn't be speculating tons of money on altcoins anyway. Again, that's a fun money like hobby, really.
Yeah. Well, one thing to wrap up, we should maybe mention it is just you spoke about the team spun out at Cambridge University, and there are some UK quantum startups of varying stripes. One, in fact, was bought by IonQ, Oxford Ionics, I think its name was, for $1 billion earlier this year, and there are others out there too. So the UK is not quite necessarily at the forefront, but certainly part of the forefront of this research. So,
so that if you think about it, there are three main strands. There's private capital, which the US is by far the biggest at raising. But in terms of state, then there's state investment, which actually is led by China. And the Chinese at the start of the year had the most powerful the fastest superconducting quantum computer, I think. Not the most powerful. I think that was still IBM. But they had so the Chinese are big investors, the biggest. The Europeans are actually the second biggest state investors. Obviously, right next door to Russia, Russian hackers. That's a bit of an impetus for them. But the third strand is universities, and the UK was pretty good at that. Unfortunately, we're pretty rubbish at raising money in recent years, and what do we have enough sort of government backing for this, or this type of investment? It's another question. But it's interesting. It's watch this space, because there's about 76 UK companies, I think, private startups in the quantum space, and obviously we've got some developments in the London Stock Exchange where we will be able to trade off, but on a secondary market, not a primary market for privately listed stocks. This may be something to watch out for. Again with some fun money in the coming years.
Well, this is our big read, as I said at the start, and there is a lot of detail in there, a lot of technical detail. If you're interested in finding out more, do take a look online and in print. We are going to wrap up today, though, with a look at healthcare, a look at the 3 UK-listed global healthcare trusts, because there have been some developments there recently, Val, set against a backdrop of rather indifferent performance. It's been a tough time for biotech in particular since interest rates rose. Why don't we start by talking about the 3 trusts, and then we'll get into what a couple of them are doing, starting with an unusual change of strategy.
Yeah, so these are the trusts that invest in healthcare as a sector more broadly. So they've got quite a lot of exposure to like big healthcare companies, think Eli Lilly, AstraZeneca, that sort of thing. And then they've got some smaller companies in various sectors, including biotech. So they're kind of like positioning themselves as a broad one-stop exposure for healthcare. And so, as you said, there's 3 of them. The biggest one is Worldwide Healthcare, which has got about 1.4 billion in market cap, so it's very growth focused. It's got some unquoted exposure. We're gonna talk about this one a little less because it's so big that it's kind of like doing its own thing in a sense. And then you've got the Polar Capital Global Healthcare Trust, which is about 470 million in market cap at the minute, and has very much been the outperformer in the past few years, has done really, really well. And its kind of defining feature has been that it's got a fixed life. So, every few years, basically, it takes a look at itself and goes like, okay, are we giving all our money back to shareholders, or are we doing something new with this strategy? And then the final one is Bellevue. So Bellevue Healthcare has had a bit of trouble recently. Is now only left with about 150 million market cap. It's growth focused. It's got a lot of US exposure, even in an area that is very sort of skewed towards the US, but they've got like about 85% of the portfolio in US stocks. And it has really not performed very well in the past few years. And so he has become smaller and smaller. The reason being that they, until now, they've had a discount control mechanism, which meant that every year investors could just decide to take their money out at the net asset value minus costs. So basically every year, the discount wouldn't widen because of that. But anybody who was not happy with the strategy or even wanted to do a bit of a shorter term play on the discount could just get their money back every year. And so that's partly why the trust has become so small, basically.
Before we talk about what it's proposing to do, I should say, as you point out, that Polar Capital Healthcare has done pretty well, yes. And the sector backdrop is very much, I think the sector of the AIC is biotech and healthcare, so a lot more riskier trusts in there, which have done quite badly. And I think over the last 5 years, that sector has lost about 15%, but Polar has made about 70%. So very much the exception, as you say, and I probably shouldn't lump it in performance-wise with the others for that reason. But let's talk about the changes, though. We'll come back to Polar in a minute. Bellevue, effectively, it wants to adopt a long-short strategy, which is very unusual for a sector-specific trust.
Yeah. So clearly the board has decided that they needed to do something. And they want to appoint a new manager, which would be Columbia Threadneedle, and replace their current strategy, which is long only, with a long short one, which generally, not a lot of trusts do that at all. The reason why they think this will work well is that healthcare, basically, you have a lot of companies that can do very well, and then you have a lot of companies that can do really poorly, which makes sense if you think about, there's a lot of drugs out there that are being tested, and then the trials fail, and then, the biotech company just loses a lot. And then you've got, regulatory pressures, everything that's happening in the US. So there's quite a lot going on. So these Columbia Threadneedle managers think that basically that gives them quite a lot of opportunity to generate outperformance, not just by going long, but also by shorting certain stocks that they think are overvalued or are not going to do well. And I mean, the strategy has worked well so far, but it has only launched in July 2023. So it's quite a short period to sort of compare it. And as you said, over this period, biotech has had a very tough time. So it's kind of like an easier life for people who are shorting stocks in this area. So it kind of remains to be seen a bit. But on the plus side, it is clearly like a different proposal to what the other trusts are doing. So yeah, if the trust was trying to get creative to survive, that is certainly one option.
Yeah, that would certainly make it stand out. Albeit, yes, I mean it's risky enough buying biotechs and trying to pick the right ones, shorting them, given the almost unlimited downside would seem to be riskier still, wouldn't it? I mean, there is an argument, a case here maybe that isn't there, that it could have attempted to merge with another trust, albeit the question is kind of out of its hands, I suppose. It would be more a case of hoping that someone like Polar might come along and take it over, perhaps.
Yeah, there is that, and then the argument has been that there's not a lot of Bellevue shareholders left, clearly, and it seems to be the part of the problem is that they already have investment in the other two trusts, and they want something different from this one, or at least that is the argument the board is going with. We will very much have to see whether it works, because the annual tender that I was talking about earlier will be gone if this new proposal is approved. But there would be, the board has said, quarterly liquidity opportunities for up to 15% of the capital. So that is still quite a lot of opportunities for shareholders to get out if this new strategy potentially doesn't do well or doesn't work. And clearly the trust does not have a lot of assets left. So, if it outperforms for a while, then people will just take their money out, and then the question will kind of present itself again.
On the subject of tenders, Polar also has one in the works because it's approaching the end of its fixed term life, as we discussed earlier. slightly different in nature, but can we say a bit about what it is proposing?
Yeah, so Polar is in many ways in a much better position because, as we said, it's performed really, really well. It's a bit bigger, so it's got some more margin, but it's coming to the end of its fixed term life. And obviously, one of the reasons why people invested in it in the first place is that they knew they were going to have the opportunity to take the money out at some point. So the proposal is a 100% tender, which would mean, everybody who wants to take the money out can take their money out. However, the trust has also said that it depends how much money is taken out effectively. So they've kind of put this sort of bar at 270 million in assets, which they say are necessary for the company to remain viable after the tender. So what they've decided to do is that they will do the tender. They will see, how much demand there is for cashing in, and then if it's over 40% of the shares, then they will rethink their option, and basically the tender is becoming conditional on this sort of threshold, because basically they think that if it goes below, one of the problems will be that the costs of the company will then become like a disproportionate burden on the shareholders that decide to stay. So effectively, it is still possible that the trust will just decide to liquidate everything instead rather than continuing.
Yeah, I mean, it would be a shame. The trust has performed well, albeit with this fixed term life, as we said. But when you're reaching that point now, it would be a shame if it were to go away, wouldn't it? So maybe I think that the 100% tender would happen every 5 years if this were approved. So that might be a way to perpetuate it, but investors ultimately will have to make that decision themselves. We have come to the end of today's show, and unfortunately we've run out of time. So thank you very much, Val. Thank you to James. Thank you to Mark, and to our producer, Maddie Apthorpe. We'll be back next week with another Companies and Markets show.